Welcome to the Market Action Podcast for Friday, August 2nd. Today's story: there were 3 lessons from this week's Federal Reserve meeting. Do you know what they were? Hello, this is David Russell for TradeStation. The Federal Reserve cut interest rates on Wednesday by 25 basis points. Looking back on what just happened, there seems to be a few interesting lessons. First and foremost is the old market saying, buy the rumor and sell the news. This adage expresses the simple idea that markets are forward-looking. Traders and investors are smart. They read the news and anticipate the future. So when they see something important on the horizon, they will act as if it already happened. That's buying the rumor, so to speak. Then when the actual event happens, they will unwind those bets. That's selling the news. Going back to the Fed meeting, everyone expected a rate cut. It was one of the most telegraphed moves ever, with policymakers dropping hints and speeches and statements for months. So it was clearly the rumor. Traders bought the rumor by piling into gold and silver because they typically benefit from lower rates. Then they sold the news after Jerome Powell pulled the trigger on rate cuts. You can use this in your own trading by asking yourself, what is expected? Is it priced in yet? Or am I chasing yesterday's news? Second, pay attention when something rallies on what should be bad news. Look at bonds. They rose to new highs even after Jerome Powell tried to strongly hint against further rate cuts. And they kept rising again on Thursday, pushing the 10-year Treasury yield all the way down to its lowest level since Donald Trump was elected president. The fact people keep buying Treasuries says something. It could be fears about the economy, or trade wars, or Brexit over in Europe, but it shows that global markets see rates going lower and lower. When price moves against the news, it shows real systemic demand for an asset, like when a high-flying momentum stock pulls back on a slight miss, but is then making new highs a month later. We've all seen this before, and it's happening now in the bond market. The opposite, by the way, is happening in oil, which refuses to rally despite bullish inventory news. The third lesson is don't fight the Fed. Last month on our Market Insights blog, we highlighted how the current situation was looking more like the 1990s. Back then, the Fed had been raising interest rates and people were worried about a recession. Then Alan Greenspan hit the pause button in 1995. The result? Growth kept humming along and investors enjoyed the famed bull market of the late 1990s. So, August is typically a weak month, and yes, we got some volatility after President Trump slapped more tariffs on China. But at the end of the day, this kind of backdrop with low rates and a healthy consumer is usually good for market sentiment. Thanks for listening to the Market Action Podcast. Don't forget to visit our news feed at insights.tradestation.com for more, and be sure to sign up for email alerts. This has been David Russell for TradeStation.
The preceding podcast was for educational purposes only. All of the symbols and trading ideas discussed were for demonstration purposes and not recommendation. Active trading is not suitable for everyone. You can find additional disclosure information on the TradeStation.com website. Thank you for listening.